Once it's good to go. Awesome. Well, thank you guys for being here today, both in person and virtual. My name is Bethany Winley, and I am a business development specialist with Ent Credit Union. I cover all the way from Monument up to I-70 in Denver, so I have a super big territory. I've been with the credit union for about 4 years now, but I grew up with the credit union. So it started in Colorado Springs in 1957, and everyone in my family is members. And now I get to work for them. So it's pretty cool how everything has really come full circle. And I'm just very passionate about financial wellness for all. I think that there's a lot of information out there. It can be super overwhelming. And so it's a privilege of ours to be able to not only educate you and help you know what your resources are, but also how to maximize those resources. And so thank you again for just taking time out of your day to, further your financial wellness. And we hope that you get a lot of value out of it. And so with that being said, I'm gonna pass it over to my lovely colleagues so they can introduce themselves.
Yeah. Hello, thanks for being here today. My name is Katie Griffin, and I am one of the community education coordinators for Ent Credit Union. And I cover Northern region, everything from Castle Rock up to Fort Collins. And I've been with Ent for about 4.5 years, but I've been in the industry for a little over 13 years. So most of that time has been spent working in the branches, which was a lot of fun, gave me a lot of opportunities to see just different situations and scenarios come through the doors with our members. But now I'm in the education department, which means you get to come hang out with y'all and do fun classes like this. So appreciate y'all having us today. When I'm not at work, I love to focus on all things wellness. So do a lot of like running, snowboarding, hiking, meditation, all that kind of stuff. And I always like to mention that because a lot of times we forget how important financial wellness is. And it can be more difficult to focus on physical wellness, mental wellness, things like that when we don't have that financial wellness piece. So that's why I love getting to these classes. They're super fun. So that, I'm gonna hand it over to Sarah to introduce and kick us off.
All right. Hi, I'm Sarah Vickers. I am also a community education coordinator with Ent Credit Union, and I am Katie's newest teammate, helping her out in the Northern region. I actually come to you all from teaching high school English, where I worked with 9th and 12th graders on planning for their futures. So we talked about college planning and career planning. And during that time, I noticed a lot of my students really struggled with financial literacy. They didn't know how much money they were going to make, how to manage their finances, what anything meant. So I helped them out during that, and I became very passionate about that part. And when I moved to Colorado recently, I wanted to do a job where I could help the community learn about financial literacy. And so I'm here talking to you all about that today, which is really awesome. Today, we are going to learn all things credit. So by the end of today, you should leave this class knowing how to check your credit score, what that number means, and some tips and tricks to improve your credit and what makes up all of that information. During this, we are going to be using a program called Minty. So I recommend you take out your cell phones and go to Minty, menti.com. And I'm going to have you type in a code, which I need to be able to see. Yeah,
I can see the code 462787.
All right, so it's menti.com.
Okay.
And then we have the code over here.
462787.
I'm going to give everybody a chance to get into Minty. Give me a thumbs up, either if you are remote, give me a thumbs up on the screen.
Mentimeter.
Mentimeter, yeah,
Okay,
that's the right one.
Thank you.
Yeah, and then once you all are in, let me know we're good. We're good, we're good. So what you all are going to notice in Minty is we're going to ask you a few questions as we go along, and then it'll show the slide that we're on. And then there is a Q&A feature in it as well. So in that Q&A feature, if you have a question that you don't feel comfortable asking out loud to the class, you can just type it in that Q&A feature and we will see it on Minty and we will be able to answer it, and it's totally anonymous. With that, we have a warm-up question for you in Minty, and if the internet is a little slow, just bear with us. So it is, when is the last time you checked your credit? So if you will just answer this in Minty, has it been within the past 30 days? Has it been within the past 6 months, the past year, never? Or do you not even know what credit is? I'm gonna give everybody a chance to answer this question. Looks like everybody so far has checked it really slowly. This is gonna be interesting. Okay, all right. So far, everybody who has answered in Minty has checked their credit within the past 30 days, which is super awesome. I'm glad you all are staying on top of that and checking your credit. And you have done so recently. So when you check your credit, or maybe you're somebody who doesn't even know what credit is, you might wonder, what is credit? What does it mean? What is a credit score anyway? So your credit score is a very complicated equation that gives you a number, and we will talk about that number and the range here soon. But essentially, the score is a numerical value for trust. So how much lenders, how much people can trust that you are managing your finances, that you're going to make those payments on time. So I have another question for you in Minty, and it is, who checks your credit score? So who's going to look at it? Who's going to see it? Who cares about your credit? Take a minute to type in some fill in the blank answers there for who is looking at your credit score. We'll wait for them to like super slow-mo, like sloth speed come in.
I get the office. With
We gotta keep it fun. Thanks to the internet, we can always have fun.
Oh, and there's always some sort of technical comedy. I was gonna say, if it's gonna stay that. Okay, so we have credit card companies, auto insurance, financial lenders, employers, other lenders, potential loaners, awesome banks, getting bigger and bigger. Me, yes, I hope you also check your credit score. I'm going to talk about why that's super important here in a minute. Awesome, mortgage brokers, sweet. So you all seem to have a pretty good grasp of who checks your credit already, but some of them might surprise you. So let's look at this list of everybody who might check your credit, yourself included. So lenders are the big ones. We know anytime we're going to need some sort of loan, be it a car loan or a mortgage loan, they're going to be checking our credit. Credit card companies as well. Somebody who's giving you lines of credit are also going to check it. Insurance companies, they also check your credit. And I don't know if you all know this, but insurance premiums might be higher if you have lower credit, because people who have lower credit tend to file more insurance claims. So that's why those insurance companies are going to be checking that credit as well. Utility companies, cell phone and internet providers, et cetera, landlords are all worried about, can I trust this person to make the payments? Can I trust this person to manage their money? Recently, a friend of mine moved to Colorado and they tried to find a place to live, but their credit score was 520, which we will talk about is really low. They applied to a bunch of different apartments and were denied because of their credit score, even though they made $200,000 a year and could prove it. It didn't matter how much money this friend made. Their credit said they can't be trusted to make those payments for some reason. So they really struggled to find a place, which is why it's important to know what your credit is, try to keep it up, manage it well, be able to check it, et cetera. Employers, like when I was hired on for credit union, also check your credit score. Can I trust this person? They're going to be talking about finances anyway. That's something that they care about. And for certain levels of military security clearance, you also need to maintain your credit score because they're going to be checking that as well. All right, I'm going to hand it over to Katie to talk to you all more about who monitors your credit and what makes it up.
Yeah, awesome. Thanks, Sarah. So we have three major credit bureaus. We've got TransUnion, Equifax, and Experian. Originally, the three credit bureaus operated on a regional level. So TransUnion covered central United States, Equifax was on the East Coast and in the South, and Experian covered the western part of the states. Now, they do all operate at a national level now, but not all creditors are going to report to all three bureaus. I'll explain here in just a second why that is important to know. Now, these credit bureaus, they then use a scoring model to put a calculation in and then produce your credit score. The scoring models we have are FICO and Vantage Score. So FICO is going to be the one we hear about more than anything else. That is the industry standard. It's been the industry standard for over 25 years. Over 90% of lenders use FICO, but just know that VantageScore is also out there. So that could be another scoring model that they're using. Now, FICO, it stands for Fair Isaac Corporation. The word fair has nothing to do with the system. It's not exactly the most fair system, but Fair and Isaac are the last names of the two folks that founded that scoring model. Now, if you've ever pulled your credit score from multiple places at the same time, there's a chance, a good chance actually, that you've noticed that your score came back different depending on where you pulled it from, right? There's some discrepancies there. And there's a couple of reasons for that, why that happens. The first goes back to what I mentioned about not all creditors report to all three bureaus. So let's say you have a car loan and they only report to Equifax and Experian, but don't report to TransUnion. Well, if you're pulling your credit score from somewhere and they're just going through TransUnion, that car loan is not going to show up on there. So that's going to impact what your score looks like. Another aspect that can cause those discrepancies in our scores is going to be whether they use FICO or VantageScore. So both scoring models, but the algorithm for them is going to be a little bit different. So if one place pulls FICO, another pulls Vantage, those numbers are going to look a little bit different also. I believe Credit Karma uses VantageScore. So if you're checking your credit at home through Credit Karma, you're going to see one number. And then if you apply for a loan and they're using FICO, it might look a little bit different. All right, it's not going to be the exact same number. The last thing that can cause these discrepancies is that while there are two scoring models, there's then multiple versions of these scoring models out there. So for FICO, for example, the latest and greatest model out there is going to be the FICO 10T, but there's also FICO 8, FICO 7, FICO 2. And every so often they're updating these scoring models to make them better and better for us as consumers, which is super awesome. But the older versions are still out there. So there is a chance, say you're again shopping for a car and you go to one bank and they request your FICO 2 and you get that score. And then you go to another bank to see what kind of rate you can get and they get your FICO 10. That's going to look a little bit different with how those scores come out. So there's all these different layers of things that can impact your score and can cause those kind of discrepancies. So just being mindful of that, just knowing that that's the case can help when you are out applying for things and you see different numbers coming back, just makes a little bit more sense. So speaking of FICO scores, what do y'all think is the average in America right now? 650? Any other guesses? Any guesses in the chat?
What's the range?
We are about to get to that.
Oh.
Yes. Yeah.
Best guess, what's the
Yeah.
score?
Oh, and we actually,
575, 625.
Okay, we have a question in Minty.
thumbs up for me. Yeah, we got a question in Minty. and
It's higher than I thought it
Hold
was.
up.
Yeah.
All right, while that's trying to pull up, we'll go ahead and keep moving forward. Hopefully that question will pop up here in a second. But all excellent guesses. The correct answer is going to be.
I think
Wow.
we might have frozen it.
This
Oh, no.
suspense is so intense. What's that gonna be? Apologize y'all for,
I was like, yeah, Minty's new to me too.
yeah.
We have some tech.
No, it's a technical.
Oops. Okay, so it's not 0.
It's gonna take it. It's got a credit score loading.
We're off. 667 was another guess given.
667, okay. You're getting close, all right,
The
so.
price is right.
So that number is supposed to be,
I think it's
ticking
going.
up as we go.
Average FICO score.
So the average in America is actually around, I think it's like 718.
It says 7-Eleven on.
Oh, perfect. Okay, so you're following, okay, thank you so much for pointing that out. So if you are following along in Minty, it will show you the slides as we go. So as we're sharing screen, if the internet here is being a little bit slow, you can still follow along. Thank you so much for pointing that out. Yeah, so 7-Eleven. So the average in Colorado is actually even a little bit higher than that. And it wasn't that long ago that the average in America was lower, and the average in Colorado was even lower than that. And just as years have passed and folks are getting more and more interested in learning about credit and getting that financial education and understanding what impacts your score, how to build it, that number's been going higher, which is super awesome. But you had an excellent question before. What is the range? Where does that number even fall in the grand scheme of things? So that range is going to be 300 to 850. And as I mentioned a few slides back, FICO is the industry standard. So that's what we're going to focus on today, just because that is what you're going to see more than anything else. So this is the standard FICO range, that 300 to 850. And if you have a friend that maybe is shopping for a car and they put their application in and they come back and say, well, my score was 880. So before you call them out and call them a liar, make things super awkward, they might actually be telling the truth. The reason for that is there is such a thing as an auto enhanced score. So the FICO auto enhanced does go to 900. So that is a thing. And a lot of times that is used when applying for cars, because that auto enhanced score, that version puts more emphasis on your history with car loans, less emphasis on your history with other things such as credit cards. Yes.
I have the question for you, if you want.
Oh, that's awesome.
Yeah,
Thank you.
it says, when seeing these discrepancies, are there ways to request creditors to report to all respective companies for accuracy and consistency?
That is a really great question. Thank you so much for helping me out with that. So typically financial institutions will have contracts with the different bureaus. So they might have a contract just with Experian. And so that's who they're pulling their score from and who they're reporting to. So it's worth asking, so it's worth asking the creditor, like, hey, who are you reporting to? And is there any wiggle room with that? But just know that typically these contracts are involved. And so it's pretty much like, this is who they're working with, but never hurts to ask the question. But that's great. Thank you so much. So the auto enhanced can go to 900, so know that is a thing, but as I said, we're going to stick with that standard range here today. And the first half of the range is actually considered poor credit. So everything up to 580 is poor credit. And if you find yourself in this area, it's okay, like you can get out of this 100%. I have seen family members in this range and work out of it. I've seen friends in this range and work out of it. It is 100% doable. And today we're going to give you lots of tools and things to think about when building your credit score to help you, either get out of this area or stay out of it and keep that higher score. Because when you're in the poor credit range, it's going to be really, really difficult to get approved for any type of loan or credit card, anything like that. As Sarah mentioned, it's all has to do with trust when it comes to credit. And oftentimes folks with poor credit, because they can't get approved, they'll end up going to what are called subprime lenders. And these are other companies that will lend to folks with poor credit, but they are going to charge an arm and a leg for it. Like the interest rates are absolutely ridiculous. So you're going to end up paying a lot more money for the same thing, just because so much more interest is tacked on. Next up, we have the mid-range. So we have 580 to 670 is considered fair, and 670 to 740 is good. So in this area, you will have an easier time getting approved for something, but there's a chance you might pay a higher interest rate than somebody with excellent credit, for example. But again, all goes back to trust. So the creditors are seeing someone in this mid-range and saying, hey, I can trust them more than somebody with poor credit, but can I trust them as much as somebody with excellent credit? Which brings us to the last section. So everything 740 and above, that is considered A+ credits. Everything in that area is A+. You will have absolutely no problem getting approved for anything that you need or want. And you're also going to get the very best interest rates that are out there. A lot of times, I've heard the kind of comparison between that A+ credit range and the mid-range is, in the mid-range, the creditors were asking, do you need this? And in A+ range, the creditors are asking, do you want this? So that mid-range is more, do you need this loan for something important? A+ credit is, hey, do you want this? Because you can have it, doesn't matter. So as you can see, there's still two different sections here in A+ credit. We've got very good and exceptional. That's all put A+ credit, then what is the difference between the two? And the biggest difference is really just bragging rights and room for error. So if you and a significant other go to apply for something, and if you're both at A+ range, then whoever has the higher score can, you have some healthy competition with it, right? But also, there's that room for error. So
There's a new question.
Oh,
whenever you're ready.
yeah, perfect. Yeah, go for it.
It says, what are some things we can do to improve our credit?
That is an excellent question. And in about 1 minute, I'm going to hand it over to Sarah, and she is going to tell us exactly what we can do to boost our credit score. That's awesome. A good question. Thank you. So that room for error. So let's say we have two people. One person has a 745 and one person has an 805. Both people made the same mistake in the same month. The 745, their score might drop enough to put them back in that mid-range. The 805, their score probably won't drop enough to bump them out of the A+ range. So there's that wiggle room, to make a mistake and you'll still be in that A+ area. But with that, I am going to hand it over to Sarah now to tell us all about what we really want to know.
How do we improve our credit?
Yes.
And what parts are it made up of? But I believe in it. All right, I have another question for you. So there are 5 different components that make up our credit score: new credit, payment history, mix of credit, length of credit, and capacity/utilization. Of these 5, I want you all to tell me which one you think has the biggest impact on your credit score. So take a second in Minty to take your guess. Okay, we have capacity/utilization. We have payment history. Oh, they're all tied. Length of credit. Somebody break the tie for me. Somebody break the tie. All right, tiebreaker at capacity/utilization. And you all are so close to being right, but it is actually your payment history. So your payment history makes up 35% of that 850 credit score. So it is almost 300 points of that credit score, a huge amount that goes into that payment history. Capacity is a close second at 30%. That is a very important factor, but payment history is still more important. And then we have length of credit at 15%, new credit at 10%, and mix of credit at 10%. Question.
This is my question.
Yes.
So I missed a payment a couple years ago. Like when I look at my credit, it says it's right at the end, like it's going to be falling off in the next couple of months.
Mhm.
Is there like an average that I can expect to see the points increase once that's gone and everything else is perfect?
Yeah, so when it comes to your credit score, like your number is essentially a snapshot of your most recent 2 years. So all of your history matters.
So it was like 2 years ago.
Yes.
Yes, it was just right at the
Yeah, so all of your history matters, but the most recent 2 years plays the biggest role. And like your score is at like kind of middle point of what do your last 2 years look like? And then that's a prediction of what the next 2 years are gonna look like. And it kind of matches in the middle. So yeah, that makes sense if that's about the.
If you want to have
So
a,
you will see, I will see some points increase.
you will
when-
see a rise. And if
That's
you
a lot.
want an estimate of what it will look like,
Mhm.
it's check your credit, which we'll talk about later. We'll kind of let you play around with like some trial and error, what happens sort of scenario to your number.
Okay.
Question.
I was just wondering, what does capacity and mix of credit, what does that mean?
I'm going to answer those right now.
Sounds
Do you have a question too?
Okay, so why does your number go down when you pay off a credit card entirely,
When you pay off a credit card entirely, why does your number go down?
even if the card's still open?
So, because
If it's-
a lot of times when cards get closed out, then like losing that line of
Yeah.
credit will make your score drop. But if you pay it off and it's still open, that should have a
It should
positive
help
impact on
and
your
not make the
score.
number go down.
So I would be curious,
like
like,
It's actually
capacity.
lower, both my husband and I had our score drop after paying off a credit card.
okay,
And not closing the card, just
no, they're all
paying
open
off
still.
the bill, it dropped.
and was anything else like going on alongside of that, or any like new
No.
applications for anything, or? No, okay, I would have to look at that.
Yeah, that was,
Like particular situation, because typically, yes, closing a card will make your score drop,
Yeah.
but just paying off and keeping it open is supposed to help build it, which is what Sarah's gonna touch on with the capacity piece.
so let's go ahead and go down into each of these sections. We're gonna talk about payment history first because it is the largest section. So payment history, essentially this is, can you make your payments and are you making them on time? So as long as you are paying your bills on time, paying them in full, this is going to keep this section looking really, really, really good. Now, when you have a bill and there's the date, you have 30 days before it's going to go to your credit, 30 days before it negatively impacts you. You still might pay late fees unless there's a grace period for that 30 days. But as long as you pay within the 30 days from that due date, you're still going to be building your credit for your payment history section. Now, for this section, if you miss payments, that's the one that impacts you the most. It's really bad to miss these payments and to not make these payments. My friend whose credit was 520, the reason why, one of the biggest reasons, is because 10 years ago, he had a doctor's appointment, medical bill. He thought his dad was going to pay it. His dad didn't pay it. And it was on his credit history for the past 10 years, showing missed payment, missed payment, missed payment, missed payment. He didn't check his credit to know that was happening. And then he's stuck with 520 credit because of all of these missed payments impacting the payment history category. To improve this category, if missing payments is a problem, we highly recommend that you all set up auto pay if possible, or notifications, so that way you have no missed payments and you are paying them in full all the time. The next category, capacity/utilization, is 30%. And this is how much of the available revolving credit are you using and carrying over each month. So say you have a credit card, it has $1,000 on it that you are able to use each month. If you use 30% or less and carry that over to the next month, it's still going to be building your credit. The next step is the 30 to 50% of that utilization. If you carry over 30 to 50%, that's not really great, but it's not necessarily going to hurt your credit either. Now, if you are using over 50% of that available credit on that credit card and you are carrying that over into the next month, then that is going to start negatively impacting your credit because it's going to look like you're using a lot of your credit and you're not making those payments.
What do you
Question.
mean by carrying it over? Do you mean like not paying it off by the end of the month?
Yeah, so if you haven't paid off that balance, if that balance is staying into the next month, and you're not paying it off, then that's carrying it over into the next month. So really, the goal is to pay it off entirely. That way you're making your payment history go up and you're not building, like you're not using this capacity too much, so it looks good. So pay those bills, pay them on time, pay them off entirely if you can, so the closer to zero you have in your capacity, the better, but really under 30% is good too. So the less you use, the better. Now, if you max out a credit line, say you have that $1,000 of credit and you go on a shopping spree and spend $1,000, the credit bureaus are going to get that report immediately. There is some talk with FICO 10T about this changing, and they're just going to be looking at the trending data for the past few years. But as of right now, it's best to just think, don't max out those credit lines. So that way they don't report and you don't have to worry about that. The next one that we have is the length of credit. If it will show up on the slide, there we go. This is 15%. And this one is the one that you don't have as much control over. So the other ones are about your own management. This one is about time. So for length of credit, the longer you have your credit history, the better. So we highly recommend, the younger you are when you're 18, starting that revolving credit, get a credit card, pay it, use it, manage all those other components. So that way you're building length of credit. And that way it goes. So with the length of credit, the revolving credit stays on your history forever. The installment credit, so those loans, they will go off your history 10 years after that payment date. So say you get a car loan, you pay it off 10 years later, that's not going to show up on your credit history anymore. So it won't help you for that length of credit. This is also made up of two categories. So the total credit history, so that first line of credit all the way to the end, and then the average age of the credit. So if you open up a bunch of new cards, that might bring your score down initially, but then the longer you have those lines open, the better. Our next two categories are both 10%. So new credit is the next one. New credit is each time you open a line of credit, that's new credit. Now, there's a difference between what we call soft hits and hard hits on your credit. So soft hits on your credit are when somebody like a landlord or an employer just checks your credit, takes a little peek, says, okay, that's what the credit score is. That's not going to impact your credit score. The hard hits are the actual applications that you make. So there, when you apply for credit, and you get that application in and they tell you what it is, that's going to show as a hard hit, that's going to show up on your credit score and have an initial negative impact. Obviously, the longer it is after opening that, making that application, the less it will impact your credit score. Now, this shows up for 2 years after you make that hard hit. So it stays on your credit report for that 2 years like we talked about. But the biggest impact with it is within the first 6 months. So if you all need to make a bunch of different credit applications, we highly recommend you space them out 6 months or more. So that way they aren't all impacting it at the same time and building and showing like maybe this person's like applying for 10 credit cards all at the same time. Why would they be doing that? That's concerning. So 6 months, space it out. That's a good rule of thumb. And then if you, the like thing with this one is if you open a card and then close it quickly, it helps with the length of credit, but it's such a small category that that's kind of up to you with that one. The next category is the mix of credit. So there are 3 different types of credit, which represent 3 different levels of trust. And one of them is kind of an installment, but I'll talk about it separately. So the first one is revolving credit. This is, can I trust you to make this payment every month on time? Can I trust you to manage this money? So can I trust you to manage the $1,000 credit card that I've given you? That's the revolving credit. The installment credit is the, can I trust you to make this payment every month for 5 years. So that's like a car loan. And then the last one, which is a kind of installment credit, is the CRE. It's the consumer real estate credit. And that one is your mortgages and your HELOCs, so your home equity line of credit. And that one is, can I trust you to make this payment, to make this commitment to pay off like $400,000 every month for the next 30 years. Can I trust you to do that? And because that one's such a big level of trust, that one can really help bump your score up into the 800 range. Question?
Somebody put one in the chat. It says, with length of credit, since it is affected by the average, it would hurt to close credit cards or credit lines?
Yeah, so that's a great question. So if you have your first card that you open, your first revolving credit, and you close that card, that's going to bring your average down because that first card is what's making up how long your credit history is in its entirety. If you have a new card that you open later, and then you haven't had it open very long and you close it, it might like kind of weirdly help your credit initially because it was showing up as a new credit and then changing your age of credit. And then once that's got rid of it, it makes it look like your credit is older rather than having that new card. But once that new card is open and it continues to build time, it can just help because it shows the longer credit and then it stopped after 2 years is going to stop showing as a new line of credit anyway. Does that answer that question? I hope so.
Makes sense to me.
Yeah, cool, awesome. All right, so those are the parts that make up the credit score. And all of this impacts a lot of factors, including how much interest you might be paying with a certain loan. So we're going to show you a few graphs here. This first graph shows a car loan of $25,000 and the different interest that might be paid based off of the interest rates that you give. So for somebody who has really good credit, say like 740, higher up into the 800 range, a lender is going to give them an interest rate that is likely lower because they're going to trust them more. And so over the life of this loan, they might only be paying 3.5% in interest, and the total cost of this $25,000 car is really going to be $27,000. Let's say the credit score is not so good, somewhere in the lower 600 range. They might be paying up to 21% in interest, which means for the entire car, they're actually going to pay $40,000. That is $13,000 more of a difference between somebody who got a good interest rate and somebody who got the not so good interest rate. This 21% APR is the maximum interest rate for a car loan in Colorado, but personal loans are not exempt from that maximum. My friend today found out that she had $40 in interest from the past like 3 months off of a like $200 bill because her interest rate is like 28% on this thing. It's crazy. It's not okay. So having good credit can really help the amount of money you're paying for these things, especially in relation to the interest rate. Another thing to keep in mind is the term that you get for these loans. So this graph shows the difference between a 60-month loan in the red and an 84-month loan in the gray. So we take a look at this person who has the 21% interest rate, and the difference that they pay, even at 21% between the 60-month loan and the 84-month loan is quite notable. At that 84-month loan, they have paid almost $48,000 for that car at this point. That really only started at $25,000. So when you all are looking for these loans and looking at these interest rates and looking at the terms, it's important to keep in mind how much more you are going to be paying in interest from having that longer loan. So we recommend shopping with the interest rate in mind rather than just looking at that. And then the other thing to keep in mind is that especially with this longer loan term, it's usually going to make those interest rates go up. So even the person with good credit, if they had gone with the 60-month, they could have gotten 3.5%, but because they're going with the 84-month, they're going with 4.5 here. So those are some things to consider when looking at different loans and how credit impacts that as well. So I'm going to hand it over
to everyone. I feel like when I first started learning about this,
it's like a lot.
I was like,
yeah. And I can answer any questions. Go ahead.
Yeah, I just wanted to pause and make sure this is like resonating with everyone. Okay, cool. Because
It's a lot, but it's making sense.
Yeah. Good.
Okay.
Good. All right, I'm going to hand it over to Katie to wrap us up. Tell us the last little bit.
Yeah, so this is dealing with installment credit, right? But there is also revolving credits. And credit cards can be a really phenomenal tool to use to help build your credit as long as they're used responsibly. And part of that is just knowing the ins and outs of your credit card, knowing when that due date is, you make your payments on time, knowing what your interest rate is, just in case you have to carry something over to the next month, you don't pay in full, how much extra you'll be paying for that purchase. And part of knowing your credit card is also what does your billing cycle versus your statement look like. We're going to get into that in just a second. But another really cool thing about credit cards and why they can be a really great tool to use when building your credit is that credit cards are really the only free way to build credit. And what I mean by that is if you put stuff on your card and pay it off every single month, you're building your credit and making those payments, showing that you can manage it responsibly. But if you pay it off every month, you're never paying any interest. So essentially, it's a free way to help build your credit up. But that billing cycle and statements. So your billing cycle is going to last anywhere from 20 to 45 days. Typically, it's around that 30-day mark. But so you have your billing cycle, and this is the time when stuff is getting charged. And then your billing cycle ends, and then your statement is produced. And then with your statement comes your due date. Like, hey, this is your due date when your payment needs to be made. So something that a lot of credit card companies don't openly advertise is that they are actually reporting to the credit bureaus on the last day of that billing cycle. So they're not waiting for your payment due date to come and for you to make your payments. They're reporting back on the billing cycle. Why does this matter? Let's say you have that credit card with $1,000 limit. You put $800 on it 1 month and you're planning on paying it off in full when your payment due date comes. But they report to the credit bureaus at the last day of the billing cycle. So it looks like you've utilized 80% of your available credit. That's going to impact your utilization. So you're making your payments on time, that is great. As Sarah went over, payment history is such a huge part of what impacts your credit, but that utilization is also a big piece. So what you can do is reach out to your credit card companies and ask them, hey, what day every month are you reporting to the credit bureaus? They have to give you that information. And then just kind of like mentally in your mind, you can make that like your new payment due date. If you can pay off your card by that date, then it'll reflect good utilization and you're making your payments ahead of time, which is great. Now, lost my train of thought. So yeah, so if paying on time is great, but if you can pay earlier, that is going to be even better. And even if you can't pay in full by the end of the billing cycle, this is what I was going to say, at least pay part of it. So that $800, like let's say you can't pay all $800 by the end of the billing cycle, at least pay some of that to bring that utilization piece down. So let's go through some do's and don'ts with our credit cards. So we're going to go back into Minty and we've got 5 statements here. So do you think this is something you should do or should not do with your credit card? So I'll give you all a moment to put your answers in there. And we'll see if it updates on our end.
Yes, that's much fun. Katie, at the end, I have something I'm going to add to the new credit part that I forgot to mention. Okay, so before we do the takeaways, I'll do that.
Cool. Did we have another question come through in Minty? You asked it. Okay.
I thought we did. Pause, go ahead. There's 2 new ones.
Okay.
Does this only apply to credit cards or regular bills too? And then with the payment cycle and billing cycle in mind, do we as consumers also have to keep in mind the time it may take to process?
Those are both excellent questions. So first one, yes, this is dealing specifically with credit cards as far as the reporting at the end of the billing cycle. So that's not a thing that you have to worry about with installment loans. And then the second question,
Yeah, you're fine. As consumers, do we have to keep in mind?
Oh, processing time.
Yeah, processing.
Yes, yeah, I would consider that as well. Depending on if you're making an electronic payment or payment by mail or anything like that, is making sure that's enough time, a few days to process so that it is in by that last day of the billing cycle. That's the day they're reporting. Awesome questions.
I have a question. So like for my credit card specifically on the app, it has a payment due date and then, so it's like on the 22nd of every month. And then on the 25th of every month, it says next closing date. What does that mean?
So that's, if I take a guess without like like actually like looking at it,
Yeah,
my guess would be that next closing date would be when your next billing cycle closes.
okay.
Yeah.
Okay. So I should have payments in by the 22nd.
Yeah. Yeah, and if, you can always reach out to your specific, because every company is gonna be like a little bit different with like how everything looks, so, if you give them a call, they'd be able to help explain that also.
Yeah, it was super confusing because like when, so when I got into this position, I was given a company card for company expenses. And every month I have to go through and itemize and submit an expense report. And it was really interesting to me because like my previous month's statement wasn't like the availability and the way the cycle runs, it's just really different. And so whoever your credit card holder is, you can always just give them a call and say, hey, when, like, I know that my payment is due on the 22nd of every month, but it sounds like your billing cycle might be closing the 25th of the previous month. So just give them a call and see what they say about we can know when your actual billing cycle ends.
That makes sense. Thank you.
Yeah, great question. Cool, all right, let's walk through each of these. We're gonna start from the bottom and work our way up. So know your balance limit and interest rate. Yes, this is absolutely something that you should do. This is really important information to know about each and every credit card that you have. Use your card to finance extravagant purchases. So this one, there's a little bit of gray area with this one. If you are using your card to make a large purchase that you have budgeted for and you are planning on paying it in full that month, you just want to use your card to like rack up rewards points or something like that, that's okay. What we don't want to do is use our cards to finance these extravagant things that we don't really need, we haven't budgeted for, things that could end up putting us in debt. So that's what we don't want to do. Treating your card as extra income. Thank you very much for everybody agreeing that we don't want to do this. Yeah, your card it's not part of your income. These are mini loans. We were borrowing from somebody else, so we don't want to depend on that as part of our budget. Decrease your reliance on cards and save up an emergency fund. Yes, this is absolutely something that we want to do. When we have a budgeting class that we teach as well, and one thing that we focus on is, get your budget together, like before anything else, figure out your budget. What do you have coming in? What do your expenses look like? Figure out how much is going toward your needs, your wants, your savings, and then also see how much you can set aside for an emergency savings. Because life happens, y'all. It happens to every single one of us. And the more we can build that emergency savings up to take care of those life happens situations, then the less we have to rely on our credit cards to take care of those things, because that is going to end up putting us in some debt eventually. We're having to use them for things we weren't expecting, hadn't budgeted for. And treat your card like cash. I love that we fell right in the middle on this one, because it's always really split. Like, is this what we're supposed to do or not? And the answer is yes, we do want to treat our card like cash. And the reason for this is because if we're treating our card like cash, then we're only using our card for the things that we budgeted for that month. So for myself, my husband and I, we budgeted $500 a month for groceries. And we buy all of our groceries with our credit card so that we can get rewards points with it. But we have that $500 in our budget set aside every month to pay the card off. So only using it for what you have, the funds to pay for it every month. That's treating it like cash. So you're using it, building that credit, and not running into that debt. A question that we get a lot of times with credit cards is, what is the best card to get? It's a question we get a lot because cards are such a great tool to use to build credit. And as far as what the right card is, it's really going to depend on every individual. Do you have to drive a lot for work or school? You might want a card that gives really good cash back on gas. If you are someone that has an Amazon addiction, like myself and half of my friends, then you might want to get the Amazon card because you're buying a lot of your items through Amazon, and then you can use that card, get the rewards associated with it. If you are looking strictly to just have a card to help build credit, then look for a non-rewards card because those will typically have lower interest rates. so that if you do have to carry something over into the next month, you're paying, that lower interest rate for it. And secured credit, if you are in a position where you're trying to build credit, say, for example, if you do have poor credit, opening secured credit can be really, really helpful. Secured credit, almost anybody can get approved for this no matter what their score is, because with secured credit, you are putting up the collateral for what you're getting. And I'll give you an example of what that looks like. Let's say I am applying for a secured credit card that has a $500 limit. I have saved up $500 and it's sitting in my savings account, and that financial institution, they're gonna put a hold on that $500, and they're holding that as collateral just in case I get this $500 credit card, run up the balance, don't pay it. They have that as a backup to cover themselves. Because remember, credit always comes back to trust. So that financial institution doesn't quite trust me yet to manage this credit card, but they have this $500 on hold to pay it in case I don't. Now I'm, using the card responsibly, using it, making payments, and showing that I know how to, manage my finances. And that financial institution can then look at releasing that hold on the $500 and get it back, and then converting that secured credit to unsecured credit. So unsecured credit just means that they're not, holding on to that collateral. So whether it's secured or unsecured, you're still building credit. So if you have that secured credit, that can be a really great way to get started so that you can build up that payment history, show you can utilize it, make your payments, and get all of the benefits that credit cards can provide. And of course, sticking with that budget, avoiding charging more than you can pay in full. And like we talked about a few minutes ago, if you can pay early, that is awesome, but at least be sure to pay it on time. So I know this is a lot of information, and I think we just got another question come through.
Is a secured credit card the same on credit as a regular credit card?
Yes, yeah, you are building credit just the same.
I have a question. I applied for a secured credit card, and I ended up thinking it was a scam and canceling it. Is there a way to kind of weed that out? Because some of them are sketchy looking, the secured credit cards. Is it best to go through my bank or?
I would, yeah. I mean, it's unfortunately with a lot of stuff that we do, there are gonna be folks out there with bad intentions and trying to get scams out and everything. But if you just go straight through your financial institution, not all financial institutions will offer secure credit, but check with yours. I would check with them first.
Yeah, they keep sending me stuff for a really low
Yeah.
Credit cards, so maybe they would do the secured. I don't know.
Yeah, definitely worth checking with them, see if they have it as an option. Cool. Cool. So yeah, this is a lot of information, and how are we going to keep track of that? So a couple different things. I know we're coming up on time, so I will get through this parts and get you out of here. But first is annualcreditreport.com. Annualcreditreport.com is a really great free way to keep track of your credit reports. You get one free copy from all three bureaus once per year for free. So you want to space them out throughout the year, right? So get one in January, 4 months later, get another one, 4 months later, get another, so that you can keep track of your credit report all year long while also keeping it free. Keep in mind though, that your credit report is not showing your credit score. This is just showing all of your history. So it's going to show all of the accounts you have, all the credit accounts you have. Is going to show your payment history. So you'll want to check through that, make sure your payments are being reflected correctly. And then it's also going to show things like your name or your maiden name or married name or other addresses that you have. Be sure you're reviewing all that information as well to make sure, weird address doesn't pop up, because that can mean somebody may have gotten hold of your social security number and tried to use your credit to apply for stuff. But I know there are a lot of other tools, and I'm actually going to skip this last engagement slide just because I know we are running out of time. But there are a lot.
Additional time, you're happy to take it.
So
Yeah,
sure?
I don't mind at all.
Okay, all right, let's go back to it. I hear from you. So there are a lot of tools out there to keep track of our credit score. And the most important thing is you're using one that you're comfortable with, because you're gonna be more likely to check it out more often. So Minty question, I hear from y'all, what website or tool do y'all use to track your credit?
While we're answering, we have a question in the chat.
Yeah.
What avenues, if any, are available when attempting to settle discrepancies between consumers and creditors? More specifically, beyond the creditor, i.e. appeal processes or whatnot.
Yeah, if you go to annualcreditreport.com, if there are discrepancies being shown, they make it super, super easy. There's a link you can click through and report that issue, and they'll work on getting that resolved. So yeah, that website, annualcreditreport.com, I highly recommend that for all things credit report, and then also taking care of those discrepancies and issues that might come up. Cool, so I got my Citi card, Credit Karma, FICO Score Bank, awesome, yeah. Credit Karma is a big one in the middle, means a lot of people put that one in. That is a really great tool to use, and one that we really like to talk to is going to be Savvy Money. With Savvy Money, creating an offer score, nice. So with Savvy Money, this is just another tool that is out there to help track your credit score. And what I love about this one is that it shows your credit score, but then it takes those 5 categories that Sarah went through of the 5 areas that impact your score, and it gives you a letter grade for each of them. So let's say you are killing it with your payment history and it gives you an A, but maybe your utilization could use some work and you get a C. And then under that category, it will give you specific things that you can take action on to help raise the letter grade in that category, which is then going to raise your score overall. So just keep in mind though, Savvy Money only goes through TransUnion. So if you have something that doesn't report to TransUnion, it's not going to show up on there. But it is free to use through our website. So you do not have to be a member, but if you go to int.com/yourcredits, you can sign up for Savvy Money for free. If you try to sign up for it elsewhere, it's going to charge you, but because we have a partnership with them, y'all are able to take advantage of that.
What did you say the website is?
So it's going to be int.com, which is ent.com/yourcredits. Y'all can sign up for free that way. Okay, yeah, go ahead.
Already did.
Oh, yeah. Oh, thank you. Thank you. That's sweet. And did we get another question come through in the Minty?
Does using apps affect your credit score?
No, they do not. Yeah. So when you pull,
I said soft.
yeah. So those are, like Sarah talked earlier about the difference between soft hits and hard hits. Hard hits are when you're actually putting applications in. Those are impacting your score, but the soft hits, like when you're just taking a peek at it, that does not impact your score. But you will see, like if you pull your credit reports, then any place like, if your bank, gives you an update on your credit or Credit Karma or anything, like any app that you use, you will see that on your credit report. But again, those are just those soft hits. It's not impacting your score at all.
Are there other hard hits besides applications, or applications is the only hard hit?
Yeah, when you put an application to get credit, those are the only times it's gonna.
Now's a good time for me to say.
Oh, yeah, go ahead, sorry.
Yeah, there was something I forgot to mention when talking about new credit, and it's called FICO rate shopping. So if you're worried about that with hard hits, but you're trying to say get a car loan and you want to know what your different rate options are, you can apply to several different ones to see what those rate options are. And as long as it's within 30 days and it's the same type of activity, it won't negatively impact your credit score. So when I bought a car a few months ago, I went to CarMax, they gave me a rate at 10%. I said, that's not great. And I went to a credit union and they said, we can do 2.5. And that's going to look like one application rather than 2, even though I got 2 different rates because it was within 30 days.
Awesome, thank you.
Does consolidation help to lower a score if you have high debt?
Oh boy, that's a really great question. So with consolidation, so we do actually have a class that touches on that and like debt repayment strategies and stuff. With consolidation, it gets a little bit tricky because let's say that you have like 4 really high interest credit cards and you're consolidating those, getting like this lower interest personal loan to pay those off. that, if those 4 cards are getting closed out, then yes, that is going to have a negative impact on your score. But you will quickly build it back up with that payment history on that low interest personal loan. So it's kind of like, yes and no, like there might be an initial hit to your credit, but making those payments is going to build it back up.
Yeah, and it looks like the person who asked said it's about 8 to 10 cards that they'll be consolidating.
Yeah, and when it comes to those, like trying to decide what debt repayment strategy is best, talking to a financial coach can be so helpful. Financial coaching is something that Int offers for free. As well, also check with your bank or credit union wherever you are, because talking to a financial coach, is having that kind of third party look at your unique situation can be really beneficial in trying to decide, okay, what route is going to be the best for me in my situation. These are, y'all have
Great
been
questions today.
amazing. Yeah, this is like
Yeah.
the best question class that you've ever had before. So I appreciate y'all so much for that.
Yes.
And if you have any feedback for us, the last slide in Minty is what was your most impactful takeaway from the session? So if you want to share anything and we use that information, just to make these classes better and better, any other feedback you have, it's totally anonymous. It's not going to show on the screen. We'll just see it on our end at the end. But yeah, thank y'all so much.
Yeah,
It's been
Yes,
fun.
seriously. And while you guys are putting in your base takeaways, I'm going to spin the wheel to decide who the winner of our $50 Amazon gift card is. Drum roll. And you're spinning, and the winner is, I wish everyone could see. Adrian.
Awesome.
So, for those of you that are virtual, I have some swag and just some information that I brought with me today. I will leave enough for you guys to come by, hit up Jamie. She'll get it distributed to you guys. There's pens, chapsticks, chip clips, in addition to some more information on Savvy Money and my business card. So if you guys want to take advantage of the free financial coaching that Ent has to offer, you do not have to be a member, even though we would love for you to give us a try. And yeah, with that being said, thank you guys so much. Your engagement has been amazing. I hope you got a lot out of this class, and we really strive to make sure that we're approachable. I had a student loan that defaulted about 7 years ago that tanked my credit. It took a very long time for me to rebuild back from that. And I know the struggle in the process, and it can be a lot, but don't get discouraged. That's why we're here, is to help you guys along with that. And it happens to everyone. It happens to people who work in the financial industry or not. So you guys are in good hands, and thank you so much for today.
Cool. Thank you. I love that you guys highlighted Int in general, because you guys do offer many free workshops. So
Yes.
please tap in, peruse the website, connect with me if you want to connect with any of the presenters today. I'm happy to do that.
Yeah.
But yeah, you can go ahead and stop recording. Of course, thank you,
Going
Jessica.
somewhere. Savvy Money is the one where you can do the trial